The Strait of Hormuz, the most important energy corridor, just shut down. Trading houses pulled their ships. Crude carriers from the Gulf stopped moving. Tanker after tanker sat idle in open water, going nowhere. Every country that routes energy through the Middle East just lost access to it. But one country does not route energy through the Middle East. That country is Canada. And here is what Canada has right now that changes everything. A pipeline running to the Pacific Ocean, moving 890,000 barrels of oil flowing west every day, not to the United States, but to Asia. An LNG terminal on the coast of British Columbia shipping natural gas to South Korea with 170 ships a year at full capacity. And 163 billion barrels of proven reserves, which is the fourth largest on Earth, with 6 million barrels a day in production. Most critically, Canada has a route that does not touch the Strait of Hormuz, does not touch the Red Sea, and does not cross a single choke point. 10 days to Asia. The Middle East route, 20 days, if it is even open. Every country that just lost their energy corridor is now looking at the only country that does not need one. And that country has been ready for this moment. Here's where it gets brutal for American consumers. The United States put 25% tariffs on Canadian energy, called Canada the 51st state, told the world we do not need Canada. Then the Strait of Hormuz shut down and the world energy corridor went dark. The country that tariffed Canadian oil just made Canadian oil the safest supply on the planet. The country that said, we do not need you, just created the crisis that proves they do. And now Canada is adjusting prices to reflect that new reality. For years, Canadian oil sold at a massive discount to American buyers, sometimes $40 to $60 per barrel, while Middle East oil moved at $10. That pricing made sense when America was Canada-only customer and Middle Eastern supply flooded global markets. But when $10 oil cannot move because the corridor is shut, it is worthless. And when global prices hit, $100 Canadian oil is not expensive anymore. It is extremely profitable. And Canada is no longer a captive supplier with one customer and no leverage. Canada now has options. The world is already lining up. India, with 1.4 billion people and 90% of their oil imported and half of it flowing through the corridor that just shut down, has less than 10 days of emergency reserves. Their top diplomat turned to Canada and said 7 words that reveal everything. We are willing to buy whatever Canada is offering. Whatever, not some, not we would like to discuss, whatever Canada is offering. That is desperation speaking. Japan imports nearly all its energy and is exposed. South Korea is already buying Canadian LNG in what might be the smartest deal they ever signed. Europe spent years cutting Russian gas, and now the Middle East route is at risk too. Oil, gas, LNG, uranium, one country has all 4, with a route that avoids every choke point on Earth. And every one of these countries knows it. They are willing to pay premium prices for guaranteed supply, and Canada is positioning to capture that value. Here is the part that makes this hit differently. The United States did not just insult Canada. The United States built Canada customer base by accident. 6 months ago, Washington told India, stop buying Russian oil. India stopped and replaced it with Gulf oil, which is the exact oil that cannot move right now. America forced India off Russian oil, then the corridor India needed shut down, and now India is buying Canadian oil at prices reflecting global scarcity, not the old captive supplier discount. The timing is almost unbelievable. February 26 India High Commissioner says Canada should behave like a global power. February 27 Canada Prime Minister lands in Mumbai on a 4-day trade visit. Same day, we will buy whatever you are offering. Same day, Saskatchewan Premier meets India Atomic Energy Department to finalize a uranium deal worth $2.8 billion covering 10 years of supply. February 28, the Strait of Hormuz shuts down, the corridor goes dark, and Canada Prime Minister is already standing in India, already at the table, already negotiating. The country they called the 51st state was positioning itself as a global energy power before the crisis even started. Let me show you how Canada got here, because this did not happen by accident. For years, Canada Home Minister called sending 97% of oil to one buyer a strategic blunder. So Canada built its way out. The Trans Mountain Pipeline nearly tripled Canada Pacific capacity. Non-US exports jumped 289% in a single year. China alone bought 100 million barrels in 11 months. Then came LNG Canada, the largest private investment in Canadian history at $40 billion, built in northern British Columbia. First cargo shipped and terminal running. This was not luck. This was a country that got tired of having one option and spent a decade building more. And Canada is not done. A second pipeline to the Pacific is coming with 1 million more barrels per day, indigenous co-owned route assessment underway, and submission expected by July. Think about that. First Pacific pipeline running LNG terminal shipping, second pipeline coming, 7 more energy projects in the queue. No other country on Earth has this combination, not one. Now, here is what this means for American consumers right now. When Canada was selling 97% of its oil to the United States with no alternatives, American refineries could dictate prices. Canadian producers had to accept whatever discount American buyers offered because there was nowhere else to go. That leverage is gone completely. Canada now has buyers in Asia willing to pay global market rates, which are rates driven by supply disruption and geopolitical crisis. Every barrel Canada sells to India or Japan or South Korea at $100 is a barrel that does not flow south at the old discount prices. The math is simple and devastating for American drivers. If Canadian oil is worth $100 in Asia and shipping costs are roughly equivalent whether going to California or going to Seoul, why would Canada sell to American refineries at $70? The answer, they will not. Canada will either demand prices reflecting global scarcity or redirect supply to buyers willing to pay it. American refineries dependent on Canadian crude, especially in the Midwest, now face a choice: pay global rates or lose supply. Trans Mountain expansion alone returned $1.7 billion to the Canadian government last year. When prices spike to $100, that number multiplies. Alberta oil sands employ over 150,000 people directly and hundreds of thousands more across the supply chain. Every dollar of additional revenue per barrel flows through the Canadian economy, not the American one. Fort McMurray, Kitimat, Prince Rupert, these are not numbers on a spreadsheet. They are jobs, paychecks, and communities seeing the benefits of diversified markets and premium pricing. Uranium deals mean Saskatchewan captures value. LNG projects mean British Columbia benefits. Pipeline construction means thousands of jobs across multiple provinces. 18 months ago, you were told Canada had no choice. Today, Canada has more choices than it has ever had, and every one of them was built, not given. Those choices translate directly into pricing power that did not exist when Canada had one customer and no alternatives. Here is what makes this moment so significant. Even when this crisis ends, and it will, the buyers who switch to Canada are not switching back. You do not sign 10-year pipeline contracts for one crisis. You sign them for decades. South Korea LNG deal is permanent. India uranium contract is permanent. The second Pacific pipeline is permanent. The customers Canada gains this month, Canada keeps. Every country that just learned it cannot depend on the Middle East is looking for a supplier that does not depend on it either. That supplier is Canada, and that supplier now has leverage to demand prices reflecting value, not historical discount relationships. Let me put the full picture together. 18 months ago, 51st state, 25% tariffs, America does not need Canada, and Canada was supposed to fold. That was 18 months ago. Today, 163 billion barrels in reserves, a Pacific pipeline running an LNG terminal, shipping a second pipeline coming. 7 more energy projects in development, the world's second largest uranium producer, and a prime minister signing deals in Mumbai while the Strait of Hormuz burns. What I'm watching next is gas prices when markets open Monday morning. If the corridor stays closed even a few days, every country without a Pacific supply route will feel it. Canada has that route. And there is a bigger question nobody in Washington wants to ask out loud. America tariffed Canadian energy, then created the crisis that made it essential. What happens to those tariffs now? And more importantly, what happens to the pricing agreements that assumed Canada had nowhere else to go? Because Canada just found somewhere else to go, and American gas stations are about to discover exactly what that costs.